Please welcome to the stage David Gopal from Wells Fargo to help us navigate the world of foreign exchange.
It's a good start. Gets me going. Good morning. My name is David Gopal. I head the Foreign Exchange Risk Management Group at Wells Fargo, and I've spent the better part of the last 2 decades working with corporations, both large and small, in managing and assessing their FX risk. So guess what? Today, I'm going to talk about foreign exchange. But let me start with a question for you. How many people in the audience follow the US stock markets? Just by a raise of hands. Okay, quite a few of you. That market trades between $100 and $200 billion a day in notional value. What about the US bond markets? Who follows that? A couple, not as many. That market trades $800 billion a day in notional value. Okay. What about the FX markets? Who follows the FX markets? Maybe a couple of you. The foreign exchange market trades $4 to $5 trillion in value per day. That's a big market. Who's trading in this market? Well, you've got hedge funds, you've got institutional investors, central banks, sovereign wealth funds. You also have corporations, very large companies, as well as some small companies and individual investors. Now, what are all these participants doing trading in the foreign exchange market? Well, some of them are speculating or investing, looking to make money. Some of them, like central banks, are trying to manage their currencies in order to manage their economies. And then there are the companies, which generally speaking are just looking to sort of mitigate or hedge their foreign exchange risk. And over the next couple of minutes, what I'd like to do is talk to you a bit about sort of the vastness and volatility of the FX market, as well as how some companies have looked to identify the FX risk in their business and start to address it. So to start with, what I want to do is talk about a recent event in the foreign exchange market. We already heard a little bit about it today, and that is Brexit. This became a big word in the financial press in the spring of this year. And essentially what Brexit was an opportunity for voters in the UK to determine whether they wanted to exit or leave the European Union. And leading up to this, all of the market experts and pundits, all of the markets in general, and even the bookies in London essentially gave almost no chance to the UK electing to leave the EU. So what happened? Well, the UK elected to leave the EU. So on that fateful day in June, the immediate reaction in the market was that the British pound dropped 8%. This is an almost unprecedented move for a major currency. Since then, the pound has continued to fall, and the prognostications are that going forward, we're going to see continued weakness in the British pound for the foreseeable future. Okay, why is this important to somebody sitting in the US and maybe working for a company in the US? Well, if your company is selling into the UK and selling in British pounds, the weakness in the British pound basically means that the dollars that you are ultimately going to get from your sales over in the UK are going to be worth less. So take a look at these charts behind me, and you can see these are charts of the British pound falling over time. Well, these could just as easily be charts of the revenue that your company is generating in the UK. Now, Brexit was one single event in the markets, and obviously a very significant event in the markets. But even before this, FX risk was on the radar for a lot of companies. Wells Fargo, about a year ago, surveyed a lot of our clients and prospects and asked them about their attitudes towards foreign exchange and their practices with respect to foreign exchange. And one of the very general questions we asked was, what is your level of concern towards foreign exchange versus what it was in the past? And a majority, 55%, said our concern about foreign exchange is bigger than it was 2 years ago, versus a mere 7% that said it's a lesser concern now. So the question is why? We didn't ask. But there are some market indicators you can look at that might show why this was a bigger concern. So for one, you can look at this chart here. This is a picture of the value of the US dollar over the last several years. And you can see that over the last 2 years, the value of the dollar has really moved higher. So what does this mean for a US-based exporter? Well, it's sort of similar to the Brexit scenario, but now more widespread. Companies that are selling overseas, generating revenues in foreign currency, are now going to see that foreign currency buy less US dollars when they bring it back. And so the value of international sales is going to be lower because of this move in the dollar. The other thing that's happened in the market is that this concept of implied volatility has also gone up quite a bit in the last couple of years. Implied volatility is the way that foreign exchange option traders essentially price how risky they think the market's going to be in the future, how much volatility there's going to be. And so over the last couple of years, what they're saying is, hey, there is a perception of greater risk that's going to be out there in the markets going forward than there has been in the past. So when you put this together, it's not a big surprise that with the strong dollar hurting corporate revenues in the US, and this greater perception of risk in the FX markets, that a lot of companies say, yeah, foreign exchange is a bigger concern. Now again, we did this survey a year ago, and since then, you can look at corporate filings pretty much across the board for US companies. There are definite themes there. You'll see most multinationals referencing the fact that foreign exchange has had some sort of a negative impact on their business. And so we have a couple of examples here. For one, you can see Delta talked about the dollar impacting them and them having weaker Asia-Pacific sales. Brown-Forman also cited the dollar as impacting their financial results, but they went on to say that because of the strong dollar, i.e. weaker foreign currencies, they actually started forecasting worse results going forward. And then finally, Coca-Cola, in their release, again referenced the strong dollar, talked about weaker revenues, weaker earnings, and effectively an adverse impact from FX of 20% on that all-important number, earnings per share, or EPS. So the risk in the markets, in the foreign exchange markets, and the impact of the foreign exchange markets can be pretty dramatic. I'd like to spend the next couple of minutes just talking a little bit about how companies can look to identify where the risk is in their business. And to do this, what I like to do is draw a bit of a paradigm or a timeline as to how I see foreign exchange impacting a business. Now, I'll start with this. Any company that's operating internationally, from time to time, is going to need to use dollars to purchase foreign currency to meet some foreign expense or pay some foreign vendors. And by the same token, these companies operating internationally from time to time are going to have sales in foreign currency, and they're going to have to convert this currency back to US dollars. As I go through this timeline, I'm going to use an example of a US-based company that's exporting into Europe or has euro-based sales. So in that scenario, whenever this company exports into Europe, and whenever it has a sale and converts euros back into dollars, if the dollar is worth less, or rather, if the euro is worth less, the company's going to get less dollars back into their bank account. So that's FX risk. Now, most companies, when they do business, generally do it on terms. In other words, you book a sale or you contract for a sale. You don't get paid cash on day one, but you book some type of a receivable. We sometimes refer to this as a balance sheet item in the foreign exchange world. So imagine our example. Our US-based company contracts for a sale in Europe. So now they have a euro receivable on the books. And between the time that that euro receivable goes on the books and they actually collect the cash, if the euro falls, the value of that receivable shrinks. And this leads to a direct impact to earnings. The company has to recognize an FX loss, foreign exchange loss, and they'll have an adverse impact to earnings from this. Now let's take that timeline one more step back. This is something we sometimes refer to as cash flow exposures. Our company that's doing business in Europe has been doing business in Europe for a while. They have some forecast of sales that are likely to occur in the future. The risk here is that if the euro falls before a sale is actually made, then once that sale is made in euros at a weaker euro level, the dollar value of that sale looks smaller, or revenues are essentially smaller. So if I kind of work through this timeline sort of in reverse, think about it this way. From the time that a company anticipates making a sale until that sale occurs in euros, if the euro weakens, the level of sales that are recognized, the revenues that are generated, are going to be worth less. From the time that sale's actually made and the balance sheet item comes on until cash is collected, if the euro weakens in that period, the balance sheet item shrinks and there's an earnings loss. And then, of course, there's cash conversion. If you try to sell euros and the euro's worth less, you're getting less cash back in. This dynamic here, these sort of three stages, is how I think most companies in the US think about foreign exchange risk. And it's a pretty comprehensive way to think of sort of an FX sales cycle. But for completeness, there are a few other things that sometimes come into play. Some companies think about their overall capital structure. If they're very global, how they think about FX risk impacts that. A lot of companies have to be concerned with earnings translation, that is, net profit generated by subsidiaries around the world. And then finally, there are a few companies that have to think about economic risk if their competitors are foreign and what the impact of the currency could have on a cost structure of a foreign company versus a US-based company. So I do want to share one more item from the survey that we did a little over a year ago. We did ask companies about their hedging practices. And 3 out of 4 companies say, we hedge balance sheet risk. You know, this is the risk when we actually are going to see FX fluctuations. Roughly 2 out of 3 companies say, we're going to hedge our cash flow exposure. That means hedging before the sale has actually been made. And so you can see a little bit of a trend here. The farther away you get from that actual cash conversion, the less likely a company is to hedge. Although, again, the majority of companies are hedging their foreign exchange risk. So what I'd like to say just in conclusion is that I hope this presentation has given you a little bit of an appreciation for what can go on in the FX markets. And I hope it also gives you a couple of things to think about within your own businesses when you think about where can FX risk impact me and how might I start to think about addressing it. Thank you all very much for your time. Appreciate it.